Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, unemployment is low in Canada, but will it last if the economy slows down? And for those who do have jobs, how we work is set to change. We'll dive in. Plus, the cost of living is high. For young Canadians, it is putting city living out of reach. That is all ahead. First, though, for the week that was in business, time for the briefs. The economy added another 38,000 jobs in May, pushing the unemployment rate to a new record low of 5.1%. In March, Canadian employers had 1 million vacant positions to fill, according to StatsCan, a record level. And many employers continue to complain about a shortage of available workers. The worst may be far from over for Canada's housing market. With rates rising, more voices warned this week that prices could continue to soften. Some economists are warning that a real estate-led recession could be in the cards if the Bank of Canada is too aggressive in raising borrowing costs. Flip to the central bank's point of view. This week, it said one of the risks to the economy is how indebted homeowners are, especially after buying a new home. But that it considers fighting inflation its primary duty for now.
The housing market, it's an important part of the economy. We are watching it closely, but our focus ultimately is on the whole economy and in getting inflation back to target.
But what happens to jobs if the economy slows? More economists are predicting that high inflation will act as a drag on global growth. This week, the World Bank lowered its outlook for the world to 2.9% growth, warning that stagflation could be the result, where high prices meet low growth.
Many countries will have a hard time avoiding a recession. It's not a global recession yet. It could, the downside risk is that it could be a global recession.
That is not a universal view. Economists at the OECD think inflation is less of a problem, though they also lowered growth forecasts because of the effect of the war in Ukraine. A new poll highlights the real cost of food inflation for some Canadians. 1 in 5 surveyed, to be exact. Going hungry has been the result. And the poll from Food Banks Canada also showed that almost a quarter of Canadians cut back on eating because they didn't have enough money for food. This summer is expected to be the hardest in the Food Bank's 41-year history as more Canadians seek its help. An extremely rare request from dairy farmers could send the price of milk higher. That's after a price hike at the start of the year. The dairy farmers of Canada are now asking for the mid-year hike because of high inflation, something that could trigger higher prices in a host of other products as processors tack on the extra cost. The Canadian Dairy Commission will make a ruling on the hike next week. And in the category of what could go wrong, Apple will let users pay later, joining a thriving industry built on consumers' need for immediate gratification. But with younger shoppers and lower income households most likely to use the service, a new take on the old layaway programs, there is concern about those vulnerable shoppers buying more than they can afford and winding up swimming in debt. And those are your business briefs. The Bank of Canada spelled out in its recent review of risks to the economy that heavily indebted homeowners who find their income shrinking with inflation or as their debt service costs rise may find it harder and harder to keep up. It's still a small component of the market, but it's big enough that the bank is watching it warily. But it also says raising rates remains necessary because of inflation. Warren Lovely is Chief Rate Strategist at National Bank of Canada. Warren, great to have you with us.
Yeah, my pleasure, Amanda.
So it was interesting to see the bank say one of the risks here is rates rising is going to have a big impact on part of the population. What do you think the bank hopes to achieve here? What are they hoping will be the outcome of this warning?
Well, look, I think the bank's required to give this warning, and they have, let's be clear, a number of times in the past. So there's really nothing new to hear the Bank of Canada warning about high levels of household indebtedness, exuberant housing markets. We've been here before. I think what's different, of course, Amanda, now is that unlike some prior warnings, now the Bank of Canada is actively and quite aggressively raising interest rates. So these risks are more acute, more real, I think warrant monitoring much more closely. And without minimizing those risks, I think the other key message the bank gave us this week is that while these risks exist, the thing they're really focused on, what they're really concerned about, is these sky-high rates of inflation.
And of course, that is their message, is they're going to keep tackling that. And we should look for interest rates to go even above 3%. We could see 4%. That's not beyond the realm of possibility, it would seem. Meanwhile, Warren, we're hearing from more and more economists that a recession could ensue, that the rising rates and the effect that has on parts of the economy could trigger, especially a housing-led recession. Where does that fit into the mix here for the bank, which is, of course, in the middle of all of it? It does not want a recession.
Well, I think first and foremost, what they're saying is that, look, notwithstanding these risks, our main job right now is price stability, or at least getting closer to it. I mean, we're nowhere near price stability, let's be honest. We've got inflation that's run far, far above their target, is going to be moving higher, not lower in the short term. So responding to these really exceptionally hot inflation readings is job one. That requires moving very quickly on interest rates. And I think that's where the recession risks start to come in, Amanda. What we have is a Bank of Canada moving much more quickly, aggressively than in past cycles, very rapid removal of stimulus from the system. And there's a worry, of course, that we could overdo it and send things into a tailspin.
All right, we've only got 30 seconds here, Warren. But meanwhile, we get another strong jobs picture. We know the market is super tight. Wages are going up as a result. How do we square that with this kind of notion that a recession could be around the corner? How quickly could that change and we see the job market be very different?
Well, for now, what we're seeing, and we saw today, really strong jobs market. We're at full employment. We know the economy's in excess demand. What you have to be doing now is responding to inflation. So get those rates up and hope for some offsets elsewhere to housing market weakness, because we know the housing market is headed down.
Warren, so good to have you. Appreciate it.
Yeah, my pleasure. Thank you.
Warren Lovely is Chief Rate Strategist at National Bank of Canada. Well, coming up, one lasting legacy of the pandemic is a rethink on how we work, from hybrid to the 4-day work week, the pros and cons of this new dawn of working. Next.